Mishek Tarwirei is 84 years old, but still has to work to try and make a living because he doesn't have a pension. After working for nearly 3 decades for the city of Harare, all the money he had been putting away as his nest egg was lost. He now sells dried fish to get by, which is not easy as he has to compete with several other vendors who do the same at Kamunu shopping complex in Harare's Mabvuku suburb. There are many other pensioners who toiled for years and are now receiving a pittance as pension due to hyperinflation or dishonesty by their employers. Many people working today have lost confidence in the pension sector, while many more who work in the informal sector do not have any retirement savings plan in place. This raises questions about the restoration of confidence in the pension sector and what can be done to compensate those who lost their life savings and are now wallowing in poverty.
City of Harare. You got 28 years, pension national hakuna. Sasa nikadai na watu mtombotekisa ndokuti nitorara. No pension, 28 years. Hapana bora sina kusenza maboy simu. Ichiri city market. Na nasi no pension. Saka yakazvinyirwa nokuwashiwa. Chandoda nchekuti date chiti Mbare yatakasenza iyo kanzuru tapiro mari tandigere sezvinoitwa na South Africa vari kuva vakuru vanhu vakura vangota vagere vari kutambirawo mari kuti arara zvino muno muZimbabwe hakuna.
This is the Rebound series with me, Farai Mwakutuya, your host in the studio. I am joined by 2 guests. Mr. Cuthbert Munjoma is the Director for Pension Supervision at IPIC. Sir, great to have you on the program.
Thank you for having me.
And alongside him is Martin Tarusenga, is the GM, General Manager for Zimbabwe Pensions and Insurance Rights Trust, ZIMPERT. Mr. Tarusenga, great to have you on the program.
Thank you for having me.
To kick off, I think let me begin with you, Mr. Munjoma, and get an understanding of the status of the insurance and pension sector as we speak. What is the status? Are institutions sound? Where are we?
Thank you very much. As you may be aware, this is a very big industry with various subsectors in it. We have short-term insurance, we've got a funeral, we've got life, and we have pensions. And I'm heading the pension side. Generally, this sector is safe and sound. It has demonstrated some more resilience over the years, notwithstanding the macroeconomic challenges that we faced over the last 10 years. The sector is playing its role, though there is potential to unleash the potential of that sector in terms of its socio-economic contribution, as well as a contribution to the national development strategy. So basically, in terms of capitalization, the sector is largely capitalized. We do have a few entities that are below the line, which are working with closely to ensure that they are well capitalized. Largely, these are a few brokers. Out of about 32 insurance brokers, we do have 5 insurance brokers which are not fully compliant. But as you may appreciate, brokers do not carry any risk. So we do not see it as a major challenge. They play a role in terms of contribution to financial inclusion, but we expect them to meet the minimum capital requirements. In terms of short-term insurers, they are well capitalized. The same applies with reinsurers. Then in terms of life insurers, we have 2 out of 12, which are slightly below the minimum capital requirements. We are working closely with those entities. We've put in place a number of measures, including reporting obligations as well as a compliance roadmap to ensure compliance with minimum capital requirements. Then from the pension side, we do have administrators. They also have a minimum capital requirement. Most of those administrators are actually meeting their minimum capital requirements. So in a nutshell, the industry is capitalized with the exception of a few entities, but I must hasten to also acknowledge that the minimum capital requirements have somehow been overtaken in terms of real value of those minimum capital requirements given our inflationary levels. It's about 37.5 million for short term, then 75 million life reinsurers. We believe the entities should have more underwriting capacity. So going forward, we are implementing what we call ZCAP. This is an integrated risk-based capital regime that we intend to roll out before year end. And in the process of implementing that ZCAP, we are also expecting that we would review the minimum capital requirements so that we have adequate buffers for the sake of protecting policyholders. Then in terms of asset quality, basically the industry has been very prudent in terms of their investments, even in the face of inflation. They've managed to salvage value through the profit of their investments. Largely, they are invested in real assets. These are our listed equities and properties, which constitute about 80% of the market. One may criticize to say they're actually in violation of our investment guidelines in terms of diversity. But I must also acknowledge that there's been somehow some regulatory forbearance given the need to preserve value. So going forward, as we register price stability, we'll be insisting as a commission to ensure that there's also compliance with our investment guidelines, especially in terms of the format of the and nature of that capital which is expected. Then in terms of profitability, basically the industry is registering profits, not just in nominal terms, but even inflation-adjusted profits. The short-term industry is writing forex business. Since last year, after promulgation of SI 28 of 2020, the numbers are encouraging. We can actually say the industry is on a rebound. Just the first quarter, gross written premium, I think the numbers were firming up on the numbers by end of this week, but it's in excess of 17.5 million United States dollars. The same applies for life insurance, particularly group life. We are actually seeing business being registered in foreign currency. With respect to some pension funds, there are some pension funds whose employers are actually paying business in foreign currency. And we are actually seeing pension contributions being remitted in forex.
So COVID really hasn't been an issue, or they've been able to weather that? The industry has been able to weather it?
COVID has had an impact on the industry, but largely we've managed, I think, to weather the impact of COVID-19, largely because of some business continuity plans. March last year, when we started to witness this aspect of the lockdowns, among other things, we actually issued a circular to the industry that there's need for business continuity. Claims have to be settled, especially for the funeral assurers, the short-term business, pension. So that was largely the case. But notwithstanding the measures that have been put in place, certainly there's been an adverse impact, especially because of disruptions in the labor market. Yeah, if people are not going to work, we've seen some pension funds requesting for waiver of contributions. Some have actually requested for paid-up status, some dissolution, given the viability challenges, especially the smaller pension funds. So generally, COVID has had an impact, especially on the investment side, particularly properties, because the tenants will be actually requesting for, for some moratorium on the render, among other things. So in a nutshell, that's the overview I would give. Generally, the industry is on a rebound.
A good bill of health that you point out there, but there's a point that you made that I would like to then just follow up on and get into the discussion, where you say, some of these capital requirements have been overtaken because of the environment we're in, hyperinflationary.
Yes.
As you say, you've mentioned ZCAP and this new regime that will try to address those concerns from an industry's perspective, but looking at it from a contributor or a member perspective, will they still see value if there's such a hyperinflationary environment and things can quickly be overtaken?
I think value, it depends on the type of product that we are talking about. And the issue of product relevance becomes very important. If we were to speak especially for the short-term business, if you're insuring your house, your car, there had been some challenges because of hyperinflation. Hence, there's that move towards use of United States dollars, so that you actually fully covered in terms of risk. The same applies with the life business. Basically, if you realize the business has largely been a funeral, because this is a defined benefit. What is driving the business of life companies right now? We are talking group life assurance, we are talking funeral. And the individual policies, you know, the term policies, the fixed sum assured policies, generally they've not been taken because of the issue of relevance. So it's actually, we are challenging the industry to say in terms of product relevance, we really needed to revisit the products, including the pension products as well. You know, we've got issues like guaranteed funds. There are a lot of things surrounding the structure of those guaranteed funds. Basically, they are made for stable macroeconomic environments. The same things with things like level annuities. Those are made generally for stable economies. So we are actually challenging the industry, and as a regulator, we are also, you know, doing a lot of research surrounding the issue of product relevance, the intention being to guide the market, especially on products that we think would be prejudicial to members. So basically, in a nutshell, I would say it speaks to product relevance, and it's a matter that we are seized with as a regulator as well as an industry.
Indeed. Let me stop you there. We need to take a short break, but I think it's very important that you gave us that background and that overview, because when we come back, we now want to go into some of those specific issues that you've spoken about in terms of relevance, in terms of, you know, member and consumer protection, which are issues. I mean, we've heard people with some very depressing stories, and those are some of the issues that we'll be tackling. It is the Rebound series. I am Farai Mwakutuya. Do stay tuned. We'll continue shortly. Every Zimbabwean wants their country to return to its former glory, and we believe that we have a role to play in doing that. So we'll be speaking to different Zimbabweans from different facets of life to share their views of what it will take to get Zimbabwe to rebound. The Rebound series comes to you every Friday between 5 and 6 p.m. on the Heart and Soul digital platforms. Join me, Farai Mwakutuya, for those incisive discussions. Welcome back. The Rebound series continues. We focus, as I had mentioned, this program is focusing on the insurance and pension sector and the role that that sector can play in terms of national development. But I think it's also important that we critically assess some of the issues that are affecting this industry at this point in time. Mr. Martin Tarusenga represents the Zimbabwe Pensions and Insurance Rights Trust, ZIMPERT. Let me bring you into this discussion, and specifically because we have seen cases and stories of people who've lost value, particularly on the pension side, people who've worked for years and are unable to get a pension, when aren't getting a pension or not getting a meaningful pension. Are these the sort of issues that your organization is looking out for, and what are you doing about it?
Yes, as ZIMPERT, Zimbabwe Pensions Insurance Rights Trust, we are a representative of consumers of pension insurance services. We are, you know, customer focused. All right. Now, by the way, we are not dealing with a general loss of value, as you mentioned. Your question says we are addressing loss of value. That cannot be traced to causes of that loss of value. There are causes. For to do so would be to get pension fund industry fumbling or groping for its way in the dark. And more importantly, it would be deviating from professional methods of resolving such a problem, which problem is where pensioners and insurance policy holders are not getting anything at all, I must say. Yes. So the appropriate question is addressing compensation. It's addressing compensation. This is what our pensioners want. We need compensation for their pensions, for their investments for long periods. As far as compensation of pensioners is concerned, The minister reiterated last year in the 2021 national budget that pensioners must be compensated, and there are two types of compensation. The one being that introduced by the statutory instrument of 2019 in February, I think it's 33 or whatever, which brought in the one-to-one. Yes, and the other is compensation according to the Justice Smith Commission of Inquiry. So in the event the minister, in the event of the minister's announcement in the national budget, the regulator unilaterally proceeded to set up a conflicted working party, I must say, because this working party consists of ZAPF, Zimbabwe Association of Pension Funds, LOA Life Office Association, and IPEC itself, the regulator. Now, these are all conflicted parties. And it was unilateral. There was no involvement of the pensioners. And for a long time, pensioners have not been involved in the regulation of, the pension insurance industry. Pensioners considered this working party to be a sure way of not being compensated. So we appealed to the minister in February. Yes. Yes. So we have been following up with the minister's office. In fact, I've just been to the minister's office, and we were referred to a Mrs. Rusike. We are here dealing with a very important issue because we are talking of pensions, long-term business, and life insurance, long-term business, not the short-term. Most people were, affected because these are long-term and they hold billions of dollars for pensioners. So we've just been to the minister's office and we referred to Mrs. Rusike, and Mrs. Rusike apparently professed that she has no knowledge of the letter, but in fact, our follow-up since February, we were being advised that the minister is in touch with IPEC and other officials in the ministry to resolve this problem, to get pensioner compensation back on track.
Mr. Mjuma, let me bring you in here. Perhaps you could update us in terms of where you are, because from what we gather, a committee was set up to address this, the issues of compensation. So where are we?
All right, thank you, Farai. The way we approached it from a holistic viewpoint, especially in terms of the pension reforms. Following the conclusion of the Justice Smith inquiry, there were a lot of reforms that needed to be implemented. The reforms can be segmented basically into 3-4 categories. There were reforms at a macroeconomic level, because basically if you look at the root cause analysis, some of the loss of value was also attributed to the operating environment, which speaks to inflation, it speaks to currency reforms, it speaks to a lot of other things. Without fixing these things, we find ourselves in the same situation.
We might go back here.
And we actually witnessed it in 2019, when we also witnessed a currency reform. Though we're now wiser, then we also witnessed inflation. It would have its impact as well. We had the reforms at a legal and regulatory level. The legislation was archaic. There were a lot of things that needed to be fixed, and we are happy the bills are before Parliament. Most of the weaknesses to do with the regulation and the incapacitation of IPEC to deal with these issues that are fixing the industry, they've largely been dealt with. There were issues to do with the business practices at an individual institution level. These are our regulated entities. There were issues to do with obscene expenses, weak records keeping, data management systems, issues of governance, issues of accountability and transparency to members. Without fixing these things, we can talk of compensation, but it will be compensation year in, year out. As we have actually envisaged as a commission, we are looking at addressing the past, but we are also forward-looking. So in as much as compensation would be very important, especially as we talk of issues of restoration of confidence, compensation without the other strategic pillars would not take us anywhere as an industry. Not because it's not important. This message we've actually highlighted to central government to say we need all the critical pillars in place. And I'm happy to acknowledge that most of these strategic pillars have been put in place. come to the issue of compensation. After conclusion of the Justice Smith inquiry, IPEC was mandated to spearhead the issue of the reforms, including compensation. There's been a lot of engagements from 2018 to 2019, but unfortunately, we saw ourselves in the same situation that we experienced prior to 2009. So that somehow took us back in terms of the progress that we had registered in implementing the Justice Smith recommended compensation framework for 2009. The priority now was on implementing a compensation for 2019. We had to issue a guidance paper in terms of, in line with the current reforms that were implemented. That guidance paper, it is sought to address basically, in simple terms, it is sought to restore people to the position they were prior to the current reform. You appreciate that there are liabilities and there are assets that are matching liabilities. Because I acknowledge in my opening remarks that generally the investment practice, they've been very prudent. And they would have some assets that are matching liabilities. So what that guidance paper sought to do was to ensure equitable allocation of those assets, including the subsequent gains that would arise after the current reform. For instance, the industry was largely invested 80% in real assets. These are the buildings. These are shares on the stock exchange. What we sought to address is to ensure that those assets are shared. So I can confidently say we've largely achieved that. We've seen, if we had not issued that guidance, pensioners and policyholders were going to get values in USD, just the same value in local currency, because of the conversion of a parity exchange rate of 1:1. So if you had a pension accumulation of 1,000 USD, it was going to be 1,000 bond. The same thing with all the policies. They were supposed to be just converted on a parity exchange rate. So we actually successfully implemented this, and there was a smooth transition from the local currency to the US dollar. So the pension accumulations, the pension increases, and everything else were informed through this implementation of the guidance paper. Then from the government side, government actually admitted the impact of the macroeconomic environment on this industry. And there was an allocation of 75 million United States dollars. This allocation, the modalities for the disbursements are being worked out by central government. Us as a commission, we're simply enforcing implementation of the guidance paper, which is totally within our control. Then would also advise government in terms of modalities for the implementation of that, for the disbursement of 75 million. Then right now we are seized now with the issue of 2009 compensation. Because these things generally would have been ideal to deal with the entire compensation 2009, 2018 at one go. Because we are talking of almost the same pool of asset. But because of the complexity of the 2009 conversion, it was easier for us to deal with the 2019, of which we are done with the 2019. The guidance for 2008 is the Justice Smith inquiry. It was very clear in terms of what needs to be done in terms of compensation. What we are doing is simply to interpret the recommended compensation framework for enforcement by the industry. From our interaction with the industry, we noted that there was varied interpretation of the recommendations of the Justice Smith inquiry. And we conducted several workshops to make sure that we're on the same page. We established the working group that my brother is referring to as an administrative arrangement, mainly to make sure that everyone is appreciating the interpretation of the recommended compensation framework. In our view, we didn't want to go back to another inquiry because pensioners have been waiting anxiously since 2009. We are now talking of almost 11 years. The Justice Smith inquiry came 7 to 9 years after the conversion. So we thought going to the policy orders, conducting public hearing on results of a presidential commission of inquiry was inappropriate. Hence our focus right now is to ensure implementation of what was recommended by the Justice Smith inquiry.
Indeed. The point I just want to, before you come in, and then the point that he made where the voice of that pensioner doesn't seem to be represented at all in your commission. Yes, as you said, it might be cumbersome to go and do these public hearings and things like that, but is there some sort of representation where the people who actually lost value sit in and are part of your processes?
Right now, they are not involved. Yes.
For starters, I want to take you back to where he gave the excuse that we can't do compensation before the various strategic pillars are put in place, which pillars include guidance papers and what have you. Firstly, those strategic pillars that they're talking about, there are none being done. The regulator, IPEC, Insurance and Pension Commission, proceeded to review the Pension and Provident Fund Act and railroaded it to Parliament, gazetted it, without consulting, publicly pensioners on what it is. And now that Pension and Provident Fund Bill is fundamentally flawed. It entrenches things that prejudice pensioners outright. Firstly, there's the formulae that were used by insurance companies that ended up giving zero values to pensioners. It's actually entrenched in that one. There are so many things, and it gives the commission arbitrary powers without any responsibility whatsoever on them. And talking about representation of pensioners at the IPEC board, this is where they should be. In part of this. There's none. If I may just say that the current commissioner and the current chairman of IPEC board, they are conflicted. They are people who ran insurance concerns that prejudice pensioners. It's not in their interest to compensate pensioners. This is why when IPEC was actually asked to compensate pensioners in the flawed recommendation in the commission, they didn't. They have done nothing until we had to appeal to the minister last year.
Let me stop you there. We need to take a break. Now, there are some issues that you raised there that we want to come back and focus on. We need to take a short break. We'll come back and continue this discussion. It is the Rebound series. I think it's important that we address these issues because it will set the foundation for us to go forward. And ultimately, when we end this program, we would like to end it on that tip where we are saying, where to from here. Stay tuned. Every Zimbabwean wants their country to return to its former glory, and we believe that we have a role to play in doing that. So we'll be speaking to different Zimbabweans from different facets of life to share their views of what it will take to get Zimbabwe to rebound. The Rebound series comes to you every Friday between 5 and 6 p.m. on the Heart and Soul digital platforms. Join me, Farai Mwakutuya, for those incisive discussions. Welcome back. It is the Rebound series. I want to begin with you, Mr. Tarusenga. When we went to the break, you raised the point where you were talking about pensioners not being represented, their voices not being heard, changes to legislation that have been railroaded, amongst other things. So the two things I want to ask you. First of all, there's the point which Mr. Mjoma raised, where he's saying, what is it that the role that pensioners would play? So if you were part of this process that has been set up, the framework that is set up to implement or to respond to the Justice Smith Commission, what specifically must pensioners be doing? What value will they add? That is the first question. But secondly, if they are implementing recommendations of the commission that was set up, surely that should be in the best interests of all pensioners because they are implementing the recommendations.
Thank you, Mr. Mwakutuya. Now, firstly, in good governance, the key stakeholders should be at the board. They should be in the governing body. You can't say that when pensioners contribute into a pension fund, then you select people from outside who are not owners of that. How will their interests be catered for? So in good governance, strictly speaking, we should have equitable representation in the supreme governing body. That is not the case for many, many years. And this is, in fact, why we have the industry in conflict with pensioners. Right. So that's my answer to it. This is why, in fact, we have the guidance. I wanted to raise the question of the guidance paper that is talking about. It's fundamentally flawed. But revaluation guidance don't. I mean, the revaluation gains or losses don't address pensioner benefits, and it can't be a compensation. The international revaluation gains is essentially a fluctuation of values in the balance sheet from year to year. They don't compensate. It's fundamentally closed. It's way off international accounting standards of compensating pensioners and of accounting for revaluation gains. It does not compensate pensioners at all. Instead, what IBEC should be doing is to actually compensate pensioners in terms of what they are supposed to get. And where is this provided for? It's provided for in the Pension and Provident Fund Act, which says that each pension fund must have a rule book, right? A rule book. The rule book specifies exactly what each pensioner should get. Now, this is what our organization does. It looks at the rule book, tells, let's say, Zupco Pension Fund. It provides for pension benefits as N 50 years multiplied by the member's final salary. So that's what it says, and this is what the pensioner in the Zupco Pension Fund has been investing for many years, 40 or so years. That's what you should look at.
So my question then is, and I suppose it's to both of you, which, and for those who are, for us who are not in the industry, perhaps it will also be very instructive. Who is actually bearing the cost of this compensation? Because I would imagine if I'm a pension fund, it's not my fault that the economy did what it did and there were those challenges. So should I be the one to foot the bill? Is Treasury footing the bill? Who is responsible for this compensation? Because it was unforeseen and clearly, I'd imagine, not in the interest of anyone for those challenges to be. Can I come in? I'll begin with you very quickly, and then
it's the pensioner, when they invest money into a pension fund, it's supposed to be invested in accordance with the investment guidelines, which investment guidelines or investment policy should say that should direct that the investments are in accordance with liability profile. For young people, the pension can invest in property, illiquid property. For those that are nearing retirement, then you are looking at more liquid assets like bonds and what have you. Right. Now, for a long time, our pension funds have been, young, they've had young age groups until about 2008, thereabouts, 2009, when they began maturing. Pension funds should have those funds. They have those funds, and there are ways, standard ways of accounting and managing those funds. So there's no question of anyone footing anything. It's the pension funds themselves. They've got the money, and regularly, the pension fund should review whether contribution rates that the pensioners and pension fund members are making are adequate. This is where we have those actuarial valuations and what have you. So there's no question of the money should be there. Okay. Now you wanted to gloss over.
Is the money there? Let's start there.
Let me respond to that. Basically, he's right that the source of funding, the primary source, should be the pension fund itself. So that's why we've been talking of the guidance paper, which speaks to assets. The pension funds invest in assets, and which asset classes. So you need to look at the asset side, then you match with the liability side. Without sounding very technical, if it's a DC pension fund, a defined contribution pension fund, which most of the pension funds in this industry are, basically, it's more of a bank account. What you've deposited in your bank account is what you are entitled to plus some investment return. So most of the pension funds are DC funds. If they are self-administered, you are talking of a pension fund with its own governance, the assets are registered in its name and so forth. It will be a question of just the reallocation of those assets, because there will be no shareholder which is involved. So it's a question now of profiling the investment. The Justice Smith inquiry did from 96 to 2016. And it was established that the monetary assets lost value. Largely, it was negative return on bonds and on money market. But the industry was invested in property and listed equity. And those would be the assets that would have to be shared. There is also a role as a source, role of the sponsoring employer, especially where there are pension contribution areas. There is a challenge of pension contribution in areas in this industry. At its peak in 2018, it was 10% of assets. So that should be also a source, because once employers make a good of that area, certainly there will be more assets to be shared.
Yes.
The same applies with some defined benefit pension arrangements. These are pension arrangements which are also guaranteed by the employer. Some of these, they are about 41 defined benefit funds. They are in what we call actuarial deficits. So the employer is supposed to inject some money into the fund. So that would also be another source. So basically we are talking of asset redistribution. But if you consider the assets that are there in the industry, right now it's about 177 billion. If you divide with the number of members, we may not get very significant upliftment in terms of benefits, largely because of valuation of those assets as well. We believe they are depressed, especially right now. If you look at the stock exchange, the property values, at its peak, it was a portfolio of about $1.1 billion USD. Right now, the property portfolio is around 600 million. So there are valuation limitations there, which speaks to the market, the forces of demand and supply in the market. So in short, I'm admitting that the source are the pension funds assets themselves. Then governments, if they do have capacity, generally governments are responsible generally for social protection. They can do it just as their own gesture, like what they've done in the 2019, in the 2021 budget. But the primary source are the assets. Hence, we are talking of equitable allocation and distribution of those assets.
So I suppose you can't give an exact timeline now, but you said you are currently seized with addressing the 2008-2009 scenario. When can we get some sort of resolution?
We have a roadmap which is being shared with the Ministry of Finance. It is going to be made public, and we hope by December we'll see some form of asset redistribution. It may not be full compensation, but certainly the industry will be contributing something towards compensation, especially for life offices where there is shareholders. For some segmented pension funds, you would say everything that is there belongs to the three of us as members. So we just share what is there. But the finding of the Justice Smith inquiry with respect to life offices has been that some assets could have been transferred to shareholders. Hence, we've been doing an asset verification exercise dating back to 2009, which will also some assets being redistributed from the shareholders to the policyholder pots.
That asset distribution, what impact could it have on the stability of these institutions? For the shareholders, certainly if it's significant, they would have to inject more capital. But if they have got adequate capitalization, it will be just a reduction of the shareholder equity in life offices. Mr. Tarusenga, the roadmap could, as quickly as this year, see some sort of movement. Does that give you some confidence that there's light at the end of the tunnel?
Not at all. As a matter of fact, he's just been glossing over issues, talking, being here and there. He talks of asset redistribution. I don't know what asset redistribution is. Each pension fund has got its own assets, and within within that pension fund, each member has got an account. I don't know what the asset redistribution they are talking about. And with regard to the roadmap, there have been roadmaps and roadmaps. We know that there's an undeclared position within the insurance industry, which is being orchestrated through IPEC not to pay pensioners their rightful benefits. We know that. We know that. And as a result, we are pushing through the minister's office. We have written to IPEC to say that the various things that they talk about, guidance papers and what have you, they're of no effect.
Would it not be counterproductive for the insurance sector not to want to pay the full value, because that undermines the confidence that no one will then be interested in taking up pension insurance, because if they don't pay out? So why would they be?
Unfortunately, it is counterproductive. But what we have got here is a serious question of insider problems. Those people that did things wrong in the insurance company, they want to continue in despite that they are incompetent. So these are benefit calculations which are wrong. So if these things were to be done, we would have a lot of people, being locked up or losing their jobs. This is the reason why it has become like a cartel, a closed-in cartel. And for them to succeed, we know that they ensure that the IPEC board has no pensioner representation, and the commission itself has got people who protect the interests of insurance companies, which are not to pay the compensation.
I want you to come in, Mr. Mjomba, but I must ask this, that if there is a commission that did its inquiry, presented findings to Parliament, that can't be swept under the carpet. So surely something that must be acted on. Are you saying that that won't be, or it can't be?
It was. In fact, if you notice how the commission was, pensioners were happy that at least that commission of inquiry, the report said that things were done wrong and pensioners must compensate it. But that's how far it went. It didn't actually go into the specific methods of compensating the holders of the various insurance policies and members of the insurance in terms of the law. It didn't. And somehow it was railroaded again through Parliament, and it ended up being the IPEC should now be compensating. And now IPEC is sitting on it.
I must allow you to respond to some of these issues, Mr. Mjomba.
Yes, let me respond to some of the issues that Mr. Tarusenga is suggesting. Particularly the issue of conflict of interest, IPEC not serving the interest of policyholders and pension scheme members. IPEC was established for the sole purpose of regulating the industry, the ultimate objective being to protect the policyholders and pension scheme members. IPEC is not conflicted. IPEC is composed of a board that is appointed after some due process within government structures. The same applies with the management. There is a selection criteria which is there. So I am not sure the allegations that IPEC is protected is refusing to compensate. In any way, it's not IPEC that compensates. IPEC is a referee which enforces compensation by the industry. And who is the industry? It's the pension fund. How is the board of the pension fund structured? A board comprises members of the pension fund. 50% are employees, representing employees, the general employees of a company. The other 50% are appointed by the employer. So in terms of representation of pension scheme members, they are represented because they govern their own pension fund. Us as a commission, we come to say, is the way you are governing in line with the regulations? Is the way you are governing in line with the laws, the frameworks that we've issued? So I don't think it's correct that IPEC is conflicted. It's running pension funds. We don't run pension funds. We don't run insurance companies. They are run by the industry. In terms of representation in the IPEC board, yes, I'm not sure. We do have pensioners in the IPEC board. And certainly they would have interest to protect. I'm not sure if he's talking of pensioners, which pensioners. We stand guided, but to conclude on the issue of the board, we are not the appointing authority of the board. They can make representation, possibly as policyholders, to the appointing authorities, who in this case are government. Mr. Tarusenga,
I want you to continue with that point, keep that point. We need to take a break. So when we come back, you must finish up and wrap up that point. We need to take a short break now. We'll come back, pick up with Mr. Mjomba, wrapping up. But as I said earlier, our focus now as we come back is to say, what is the way forward? The Rebound series continues. Every Zimbabwean wants their country to return to its former glory, and we believe that we have a role to play in doing that. So we'll be speaking to different Zimbabweans from different facets of life to share their views of what it will take to get Zimbabwe to rebound. The Rebound series comes to you every Friday between 5 and 6 p.m. on the Heart and Soul digital platforms. Join me, Farai Mwakutuya, for those incisive discussions. Welcome back. My name is Farai Mwakutuya. My two guests, Mr. Martin Tarusenga, representing ZimPert, the Zimbabwe Pensions and Insurance Rights Trust, and Mr. Cuthbert Mjomba. He is the Director for Pension Supervision at IPEC. Mr. Mjomba, you were about to wrap up your response to some of the issues that were raised.
Yes, I also wanted to respond on the issue of pension fund rules. He emphasized that each pension fund should have a rule book, which is actually the case right now. That's the constitution of a pension fund. And what we've been doing as a commission is to ensure that those pension fund rules are tight enough to ensure protection policy scheme members. So we've actually called for every pension fund to resubmit, and we are actually re-registering all pension fund rules to do with the issues of consumer protection that Mr. Tarusenga raised. He is undermining the importance of other strategic pillars for the success of this industry, which I would want to beg you to differ with. Certainly, there are fundamentals that have to be there. The role of macroeconomic stability cannot be undermined. The role of enabling legal and regulatory framework, the role of effective institutions, strong institutions in terms of governance, the issues of disclosure, the role of trustees themselves. Because trustees are running these pension funds. They have to bring their administrators to account. We are actually implementing a lot of reforms in that regard. He is also, it appears, we always engage Zimpet as a commission, but it's unfortunate that they appear to be differing with everything. The laws, there is a law-making process which is observed. The principles are approved at cabinet. They are submitted to the Attorney General. Consultations are done. Parliament does consultations. But as long as his views are not taken on board, then everything will be fundamentally flawed. So it appears everything that we are implementing, possibly he can be the regulator. That's what we are seeing here. Possibly he wants to be regulator. But we take criticism very positively. If you ask him almost everything, we consult with him. Just we're together at Parliament discussing pensions bill. The IPIC bill will be before Parliament. The insurance bill will be before Parliament. And he appeared to be disagreeing with everything. So yeah, I think it's their right as a rights group to disagree with almost everything. But we are a listening regulator. We do listen. We consider some of the proposals that they are submitting. Thank you.
I want to say, Mr. Tarusenga, he's just mentioned pensions bill, IPIC bill, all these things that are being brought before Parliament, which I understand you've also had insights or have certainly heard about. What are they intended to achieve? And I suppose in answering that, what are the challenges that you have with them that you would want fixed so that they become something that gives you and your members comfort? So essentially, how do we fix what is currently there?
Thank you. The Pension and Provident Fund Act and any other legislation, that guide the pension insurance service provision in Zimbabwe is supposed to protect pensioners. They are not. And the reason why for your own information, that bill would go to Parliament, and Parliament actually saw the wrongs with that bill, the flaws with that bill. And as recently as April 4th to 9th, they had to stop second reading, I don't know the terminology, and public hearings were held in which pensioners complained vehemently against IPEC. So it's not what is just talking about glossing over issues, it's generalizing issues. These are issues that parliamentarians actually saw that this thing is flawed, and our submissions need to be taken into account, right? So as of now, we are waiting, for the report of, those public hearings to be heard in the Parliament. So they are supposed, those pieces of legislation are supposed to protect pensioners. That's the long and short of it. And the regulator is supposed to protect pensioners. You don't have if I may just finish. I've got experience in the UK, working in the pension insurance industry, actuarial services specifically. You don't have a regulator who is being told by pensioners, the pensioners that they're supposed to, and policy that they're supposed to protect, being told in 2009 that something is wrong here, and to date, 11 years later, is it 11 years or more? 2021, nothing has been done, and he's talking of a roadmap, and yet there's nothing. Now, I personally worked on a compensation program in the UK. There's nothing. You just put in professionals. You look at the rules or the policy document. What does it say? Was it done? It wasn't, and then you address that. So they keep talking about roadmaps and what have you.
I'm going to come to that, but let me just ask you this. I mean, he's just said he's not the appointing authority. IPEC is not the appointing. They get appointed. So these representations, these issues that you have, when you have taken them up with government, Ministry of Finance, whichever sector it is, what responses do you get?
Right. As I said just this morning, we were asked to follow up with the minister's office, and we did, regarding the letter that we appealed to the minister against that working party body, which is conflicted. All along, we were being told by the minister's office that it's being addressed. The minister is written to his officials, and the officials in turn, and the minister, they've also written to IBEC, and we were being told that there were meetings according to, we held to discuss the issues that we raised. And I must say that at minister's level, we were being told that he's earnest in addressing it. And we believe him, because when we appealed last year for compensation to be put back on the table, he did respond and put that compensation in the 2021 national bill. And what do we see? IPEC introduces insurance companies, to compensate pensioners. The very same person that prejudiced pensioners. I mean, it doesn't make sense. And now the next thing we are being told in this program, that there's a roadmap. So there is a disjoint somewhere from the minister's office to IPEC.
I think that Mr. Jarusenga does have a point in that 12 years later, is it fair for those people who toiled and worked to still be told we're at roadmap stage?
Certainly, it's not fair for the policyholders. They are actually inundating our offices in terms of that compensation. But I think we need to move away from blame game. We don't think blame game will take us anywhere. There was a root cause analysis which was done by the Justice Smith inquiry. The problems, the root causes, they were identified. Solutions were proffered. And what we are supposed to be seized with as part of the reforms is to deal with the root causes. So if macroeconomic stabilization is an issue, we deal with that. Weak regulation on the part of IPEC, we deal with that, and we can actually say this is what we've done. The running of the pension funds and the insurance companies, we can actually explain this is what we've done. The only challenge which is there is pension is long-term. You are talking of somebody who said, I started working from 1980 or 1979, and I lost the value through some structural reforms in 99, maybe through demutualization of old mutual. You go into hyperinflation. You go to currency reforms, which is 2 episodes. It's not something which is very easy. We normally interact with Martin. He just does some computations to say, Farah, you started working when, okay, how much were your contribution? This is the amount, convert it in dollars. There are assets that are matching those liabilities, and they differ from product to product. So as a commission, we highly appreciate the need to close these things, because they have certainly affected the confidence in the industry. And just that, because we are talking of long term, the efforts that we are putting to date, people may not appreciate them, because they say, I lost the value. I need to be compensated. You ask, what is the source of compensation? You asked a very good question. What is the source of compensation? If you consider the assets that are there, certainly they will not fully compensate. But you are not saying they mustn't compensate. We did something for 2019. We ensured an equitable valuation, allocation of those assets. Then in 2009, we are going backwards. We are talking of data series dating back 2 years. It's not something that you wake up today and you say, pay this much. But certainly, certainly efforts are underway to ensure that the compensation.
Let someone else.
We don't compensate. We don't compensate as a regulator.
Indeed. You mentioned there being forward-looking. So I want to ask, I think things that are quite pertinent, certainly feel are quite pertinent now. What do you think about the future of this industry, of this sector, or certainly going forward, given the fact that now people may not work? We are in a highly informalized economy, so contributions may not be, available, and people, it's unlikely that people work until 65 anymore, because we are being replaced by technology. Younger people are coming up. So, what does that mean for the future, and what is being done to make sure that we adapt to these new realities?
Certainly, there are a number of things that have to be done. First, at an industry level, there is issues of product relevance that we've been talking about. If you consider what is driving business right now for life offices, you are talking of group life, you are talking of pensions, or you are talking of funeral, which effectively means those are products are meeting the needs of the people. People are being buried, and certainly you appreciate that I do have a product. The same applies with pensions. Pensions, old age is certain. It's as certain as death. So we can never say, despite notwithstanding the challenges that we face as an industry, we cannot say pensions are no longer relevant. It's a question, the question that we should be seized with, how do we make a pension relevant in the case of Zimbabwe? So addressing issues of legacy loss of value would certainly go a long way in addressing those challenges. We need to address the question of product relevance, which the industry and us as a regulator were already seized with. We need to deal with issues of consumer protection through our enhanced supervision and monitoring, among others. Then we need to also deal with issues of economic growth, because this sector writes its performance from the performance of the industry. Where there is economic decline, you cannot expect this sector to perform in isolation, because there's a positive correlation between the performance of the economy and the performance of the sector. It's unfortunate that if you are assessing these things, we normally do finger pointing. I don't think we should be doing finger pointing. What we need to do is to say right now, we see the positive gains that are being registered under TSP and under the NDS. Once we have economic growth, certainly there will be revival. With respect to the informalization of the economy, we need to tap into those into the informal sector. So there's a role of microinsurance, which we believe the insurers right now they assist with that. Most of them have made inroads, being traditional insurers, tapping into the informal sector. And one product that they've sold extensively is funeral. It has actually even penetrated the rural areas. So we look forward to more products that are tailored to the need of seasonal workers. The same applies with the micro pensions. We are working closely with the other regulators in the region that have taken strides in tapping into the informal sector. We are going to be launching a micro pensions framework beforehand. The intention really is to target the informal sector, but you can also target them before addressing legacy issues that we are actually discussing, issues of compensation, issues of adequate regulation, among others. So I see the future is bright, notwithstanding the challenges that we face as an industry.
Mr. Tarusenga, apart from representation of pensioners on the IPEC board, which you've made mention of, apart from this issue of compensation being paid, what else do you think are the key priorities for this sector for it to remain sustainable?
The key thing, Faraj, is to reconfigure regulation. What we have here in Zimbabwe is an obsolete type of regulatory framework in which some people somehow campaign to government to get on board into the IPEC board, and you get cronies being appointed as commissioners. We need to reconfigure regulation and ensure that regulation plays its primary role, which is to protect pensioners, to protect policyholders and other consumers of insurance policies. As long as we have a regulator that keeps giving excuses and talking of roadmaps and talking essentially nonsense about the guidance papers which are wrong, which actually breach other statutory instruments, we will not get anywhere. So Farai, we need to have a comprehensive review. Already in developed economies such as the UK, we now have Financial Conduct Authority, which actually homes in on reviewing transactions between the consumer and the insurance company. We now have Prudential Regulatory Authority, PRA, which goes into the technical bits of how a pension fund ensures that it's got enough capital to pay its pensioners. And we now have a serious, ministries that ensure that that conduct authority is perfect. that and they are comprehensive, regularly reviewed. So that is the key issue.
On that very passionate point, we must end this discussion. But I must say earlier, Mr. Mjoma did make mention of ZCAP amongst other, other reforms that are coming our way. So I think going forward, what is key, and I think what I observe here is the need for, reforms, as you say, the economy to perform, because this industry does not operate in isolation. And perhaps from where you are coming from is the issue of regulation, but taking it up perhaps from the appointing authority point of view. But certainly I must thank you gentlemen both for coming. I hope it is a discussion that we can continue to visit as we go along here, perhaps as we head towards December, and if there is progress in terms of that roadmap, to find out where we are in terms of that compensation, because I think it is a very topical, very relevant and pertinent issue. But thank you so much, Mr. Mjoma.
Thank you.
Thank you so much, Mr. Tarusenga, for coming through to the program. It is the Rebound series. My name is Farai Mwakutuya. As always, thank you so much for joining us, and be sure to join us again next time. Bye-bye.